Ted, I'm really excited to talk about this company. And for any of those who are not in the UK, Boohoo is essentially an e-commerce company. It sells fashion items, clothing. They're particularly targeted at the younger demographic. So if I notice this correctly, the 16 to the kind of 22, maybe 25. But they've been doing really well recently. Actually, they've been in the news for a number of reasons, some not great. But recently, they've been in the news. They've acquired about 80 million pounds worth of stock and items from a couple of failing retailers during the COVID pandemic. And that got me thinking and us discussing, what's behind those numbers? How well are they doing? And does it justify the share price?
Well, hi, Moeed. Good to see you again. You're absolutely right. Not only were they buying the stock, don't forget really what they were buying were the brand names. So they people like Debenhams, for example, they're picking up the brand names, but they were leaving the actual physical stores because, of course, Boohoo are online. So let's have a look at their financials and see how they are performing. So here we see their income statement and top line. Previous year, about 900 million pounds, and it's up to 1.2 billion. So they are growing very, very rapidly. Here's their gross profit. Here they're working on roughly 50%, 55% gross margin, which is pretty good. Kind of expects what you expect from the this industry. So they are, they buy a shirt for £5, they sell it for £10, that kind of thing. Down the bottom line profit, they're still profitable. They're only making about a 6% margin. So they've got a lot of fulfillment going on in here. So you'll see distribution, their distribution costs are pretty high. Okay, so the way to think about these guys is that they're online rather than physical stores. So they don't pay for rent and rates, but they do actually have to pay for postage. So there's a kind of bit of a trade-off going on here. But it's a strong looking company. They got it's nice, it's profitable, it's growing. They've got a good business model. They run things like Love Island, for example. Then all the people on Love Island wear their kit, and then the advertising. So PrettyLittleThings.com is part of their brand, their group of companies. So very, very effective marketing. A little bit like we were talking about Gymshark. They've really worked out the route to market rather than the traditional more sort of staid companies. If we look at their balance sheet, again, balance sheet is pretty strong. There's nothing there that really jumps out at me. The key, I think, really is that there's basically no debt on the company. So the non-current liabilities are effectively zero. There's no debt. They don't need any debt. So they've got about, 327 million pounds worth of net assets effectively. Lots of cash. So very, very strong in terms of their cash. So these guys, they're thriving. They are one of the winners, certainly in the lockdown, for example, and they're doing incredibly well. Just worth bearing in mind, you talked about this kind of the additions going on. So this number up here. So here we see the property, plant and equipment is the biggest numbers in their non-current assets, but we notice here the intangible assets will probably be the goodwill. So when they're buying a company, they're buying the brand or the reputation, for example. They get the net assets, but they're actually buying the brand. And that's where you see a significant increase going on there. And as they buy other companies, which will be part of their growth model, they'll effectively be buying good brands, plugging them into the Boohoo distribution model and trying to create exponential value through that route. But yeah, it's looking a good business. So let's have a look at their share price. We see that first of all they're trading on a P ratio of 50. So that's a lot. That's quite high. So 50 times earnings. And really that's reflecting the growth. So this isn't a mature company that's now going to carry on making the kind of 75 million a year profit. What it's saying is that 2019, it was about 48 million. 2020, it's making 73 million. And we're starting to project that, it'll then be 100, 150, 200, 300, 500, et cetera, et cetera, et cetera. So really the challenge here is, if you buy into the growth story, if this is a company that's making turnover of 1.2 billion and in 10 years time will be turning over 100 billion, then I reckon this is definitely a buy. But if this is a company which is, it's kind of, it works in today's environment, but, youth, fashion, very fickle, and actually there's going to be some new player on the horizon and it's not going to survive, then it looks like there's a lot of good news already baked into the price. Right. So the market value, 4.2 billion, compared with the net asset value of the actual business, that's the breakup value, if you remember, is about 3 billion. So really, there's a lot of inherent goodwill in that price already.
Yeah, right. So what you're saying is this price seems to have already factored in the future growth. So it's not at a discount, in your opinion.
Absolutely, and I think don't forget, we're spending a few minutes looking at the key financials. There are analysts in the city who are poring over this and producing very sophisticated models, projecting out into the future with scenario analysis to come up with what they think is a really accurate price of the stock. So we're being very kind of broad brush, but what we're saying is that it's a great performing company, and it's already reflected in the business. Now, don't forget, we looked at some other ones where we looked at Tesla, which was okay, but was massively overvalued. So there was a kind of, it seemed to be massively overvalued. Whereas we look at Facebook, for example, which is massively profitable, but maybe is undervalued. Facebook on a trade P ratio of about 20, Tesla over 1,000. So 50 times earnings. If they don't grow, it's going to take you 50 years to get your money back. But they are going to grow. They are growing at the moment. I mean, the question is, how much are they going to grow? Are they going to? You remember Facebook from 2003 to 2010? It was just massive exponential growth. Can these guys achieve the same thing? Could they take that model into Asia, into America, for example, or are they going to find it a little bit difficult? Are they going to grow through acquisition? So, maybe with their growth story, it's not unreasonable to pay 50 times earnings. It's just, there's a lot of good news. It's baked into the share price. Let's leave it like that.
Okay, good. And for those viewing this, use this as one of your equations for your homework, right? Don't just take our opinion. They are our opinions, but it's from one perspective in terms of the financials. But as Ted says, there's a lot that goes into valuing the price of a business. So use this as one part of your homework, but go out there, research. But we'd love to hear your opinions here, right? Do you think Boohoo is fairly valued? Do you think it's a great company? Do you think it's not such a great company? Why do you think that? Leave your comments, like, share, subscribe to both of our channels, and you will be informed of more videos that we're doing on various new companies. We're doing a ton more now, and we're probably posting about 2 or 3 a week. So like, share, subscribe, and we'll see you on the next video. Thank you, Ted.
Okay, good to speak to you.